This week, the national accounts for the fourth quarter of 2024 were released. It's the most comprehensive overview of what's happening in the Australian economy. And it showed that total output increased by 0.6% in the quarter and 1.3% over the year. That's gross domestic product, or GDP, as economists call it. While that was a bit stronger than recent quarters, it's still relatively slow. And the reason for that is that private sector demand has been weak for a while. For most of 2024, public sector demand has driven output. In the fourth quarter, though, we saw both public sector and private sector demand increase. Now, a primary reason for the weakness in private sector demand has been that the Australian consumer has been really squeezed. Household incomes had previously been declining because of the effects of inflation and a rising tax take. And as inflation's declined and the Stage 3 tax cuts came into effect in July, we've seen a little bit of relief for the Australian consumer. And so spending has picked up a bit in the last few months, and our own data show that that has continued into 2025. But it hasn't been a particularly emphatic pickup. Indeed, the increase in consumption has been smaller than what you would have expected given that the tax cuts happened. Our own Westpac DataX consumer panel revealed that most households that received a tax cut probably spent only 25 cents out of every extra dollar that they got as a result of those tax cuts. And that's a lot less than what historical experience would have led you to expect. And indeed, the national accounts consumption numbers also showed a pickup, but a bit less than what a lot of people would have expected. Now, one of the other big questions around the Australian economy has been growth in productivity. And this is something that's puzzled a lot of people. One of the things we've noticed at Westpac Economics is that a large part of the reason for the weak measured productivity growth in recent times has been the switch to the care economy and a decline in coal production. And these have been dragging down measured productivity because all measured productivity is output divided by hours worked. Part of the problem with measuring productivity in the care economy is that health and social assistance, education, and public administration are not industries that operate in a market with a market price. So you can't actually really measure output in the same way as you can with the rest of the economy. And this means it's hard to measure any productivity growth. In recent times, measured productivity growth in those industries has actually fallen, as it has in the mining industry because of the decline in coal production. Measured productivity growth in the rest of the economy also slowed over the year, but it's still positive and we don't expect that softness to continue. One of the other questions this shift to the care economy makes us mindful of is that at the moment, employment growth in the care economy has been stronger than its overall share of the economy. The care economy accounts for about 27% of hours worked, but recently it's accounted for about 80 to 90% of the jobs growth. And that's not going to last forever. So there is a bit of a question about whether the rest of the economy will see enough of a bounce back in employment growth in future to fill the gap as growth in the care economy employment normalises. In the fourth quarter, we can also see from the labour accounts data, which was released today, this week also saw the release of the labour account data, which revealed that while growth in employment in the care economy is still strong, there has been a little bit of a recovery in employment in the rest of the economy. And that's a good sign because it suggests that maybe we won't see a real slowdown in the overall labour market as the care economy normalises. But this is still a risk and it remains to be seen how things play out from here. But of course, all of these data are for the fourth quarter of 2024, and we're already in March 2025. And so a lot of what we reported today seems like ancient history. A lot has happened since then, particularly in the world economy. The geopolitical situation has changed a lot, and we're seeing big shifts in trade, including Australia's exports, as people try to get in ahead of the US tariffs. Market pricing has shifted quite a bit in recent weeks. US consumer sentiment has softened. And at the same time, we're seeing announcements on defence spending by the European governments. So a lot can change very quickly, and we'll be watching for the effects of these developments on the Australian economy. For now, though, we're seeing a reasonable pickup in the domestic economy and broadly in line with what we'd previously expected.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.